Hi, everyone, and welcome to BankNotes, a new monthly podcast series from S&P Global Ratings, in which we will cover topics of interest to bank credit investors and analysts around the world. These conversations are aimed at giving you a clear, credit analytical perspective on the banking industry. My name is Osman Sattar. I'm your host for this podcast. And today we're diving into the findings of our G SIB Monitor 2025 report, Powering Through. I'm joined by two of the report's key authors, Nicolas Charnay in Paris and Browne in New York. And they're going to help us unpack what's happening in the world of global systemically important banks, the G SIBs. Thanks both for joining us today.
Thank you, Osman. Pleasure to be here.
Thanks, Osman.
Nicolas, maybe you can kick us off. Please give us an overview of the G SIB Monitor report and some of the key takeaways, how we see G SIB's performance against what's a pretty weak economic outlook. How do we see G SIB's performance and ratings? What might drive changes in those ratings?
Thank you, Osman. All right, so maybe let's start with a bit of definition. So you mentioned these global systemically important banks, so-called G SIBs. They are defined as such by the Financial Stability Board on an annual basis, looking at a set of indicators related to their size, their complexity, their interconnectedness, and also their importance to the financial system. There are 29 G SIBs recognized in the world, and in our report, we cover 27 of them. We only excluded a couple of US custodian banks from our report because we feel that they have slightly different business models, so are less comparable. If we look at the rating of this peer group, we can see that all the 27 banks that we cover have currently stable rating outlooks, which results from their resilience to the current macro uncertainties that we see and the weak economic environment that you mentioned earlier, Osman. In terms of rating level, the ratings range from A- to AA- for this peer group, which, if you look at our global scale for rating, is a relatively high rating level. But if I compare to other banks globally, and including, for instance, some large regional banks in the US or some domestic national champions, as we would call them in Europe, we don't see a rating advantage for G SIBs. So we have other banking groups that achieve the same rating level. And I should add that within that range of A- to AA-, most of the G SIBs are actually in the A and A+ rating level. We only have a few outliers, positively and negative. You mentioned indeed a pretty weak economy that we see. It's true that the outlook is impacted by that, and that our economists have been downgrading their forecast for world GDP growth this year and next year compared to their previous forecast. So they now expect 2.7% growth for the world this year and 2.6% next year. So that's a material downgrade. And of course, it's related to the trade tensions that we see, especially since early April. Now, that said, from a bank analyst perspective, I think we still have positive growth and no recession prospects in the major jurisdictions where these G SIBs operate. And we should also keep in mind that we have a normalized interest rates environment. So interest rates are coming down now in many jurisdictions, with the exception of Japan. But they remain positive, and this is an environment that is not too penalizing for bank profitability. And also, importantly, liquidity remains ample in most jurisdictions. So these are not entirely negative credit conditions for banks and G SIBs. And so I think this view of the credit conditions underpin a bit of forecasts for G SIBs this year and our stable rating outlooks that we have. And if you look at our forecast, we see profitability remaining fairly solid this year, although slightly declining in terms of revenues compared to last year. The main reason for the relative slight decline is lower lending growth that we expect for this year for these banks, and also potentially lower investment banking revenues on the back of the business uncertainty that we see generated by the trade tensions. But overall, again, we expect profits as measured by return on equity, for instance, to remain fairly solid across the board. Let's say where there is maybe a little bit more uncertainty is around the level of credit charges that the bank will add to their P&L in anticipation of lower growth. And we've seen in the first quarter already some additional hikes of provisions. Now, I think one of the value of the reports is also to provide this side-by-side comparison between the various G SIBs. And in our charts, we have put them by regions. And I think an interesting feature of the report also is the ability to compare across European and North American G SIBs? Because we often get this question, and the presumption of the question is typically that US banks, US G SIBs would tend to fare better than European G SIBs, which I think the report shows that to some extent this is true in terms of financial performance, but from a rating standpoint, and I think it's a key point of the report, there's actually not that much of a rating gap between European G SIBs and North American G SIBs. What we see is more a couple of exceptions. And here I could call out, for instance, JP Morgan, which is rated now AA- due to its track record and its superior profitability over time. And I think our report illustrates that compared to peers. But if we set that one exception aside, I think we have a relatively tight peer group in terms of rating levels between Europe and American G SIBs. So that's maybe an interesting thought compared to some of the questions that we typically get. I leave it at that for now, Osman, but happy to dig into any of those topics.
Yeah, I want to explore actually a bit further. As you said, the report is really good in putting the banks side by side and giving that comparison. So I just want to explore a bit further that US and European G SIBs, maybe from a broader perspective. The publication has some pretty interesting angles on this, touching on market cap, among other things. So Nicolas, maybe you can give a bit of an overview of that, and then maybe we'll turn to Brendan for a US angle as well.
Sure, happy to say a few words on that. So indeed, it's a question we get a lot from investors, which is this comparison in terms of competitiveness and performance between European and American G SIBs, especially US G SIBs. Like I said, in terms of ratings, if we set aside JP Morgan, there's not much of a rating gap. All of these banks are in the A to A plus rating level in the end. They get there through different constructions, but ultimately we see similar levels of credit risks. Where we see a large gap, and that's a persistent large gap, is more in terms of equity market valuation. And as you say, we have a couple of charts there showing how about 12 years ago, 2012, 2013, the price gap opened in terms of price to book ratios between European and US G SIBs. And this coincided with a couple of events, I think. One was the Eurozone debt crisis that we had in Europe. And the second one was the introduction of tighter regulation and supervision, especially by the ECB. So I'm not an equity analyst. I don't know what was really the driver that for this gap to open, but it's a fact that it opened and it's been there since. And now we are in a situation where most G SIBs in Europe still have price to book ratios that are under 1, versus in the US, you have many banks. I mentioned JP Morgan earlier is above 2 times price to book now. So is that a problem from a credit perspective, which is what we are looking at S&P, of course? Yes and no. No, because as I said, there's no big rating gap between these banks, or it's not directly a rating factor, the equity market valuation. But of course, yes, in a stress situation, the fact that the bank has a low price to book value means that it can have more difficulties to access additional capital, should it need to do that in a stress situation. And also it could precipitate a lower confidence from certain stakeholders, like depositors, for instance. So this is something that we watch, but that is not directly impacting our ratings. So that's one gap. And then if you look at the forecast that we have across the board in all these charts where we compare the performance of the banks, you would see that in terms of profitability, we see a gap of about 300 basis points in terms of return on average common equity between European and US G SIBs. To some extent, this can also be explained by a few outliers. In Europe, for instance, we have some mutualistic group which tend to pile capital, so they have very high equity capitalization levels. That impacts their ratios, of course. And if we look at other credit metrics, we see also differences, for instance, in terms of capitalization levels. So we compare the tier 1 ratios, we see slightly higher numbers for European banks. And there's another well-known difference across the two sets of banks, which are around the levels of non-performing loans, which are higher in Europe, and credit charges, which tend to be larger in the US, referring just different approach to credit risk management. I think this is a known fact in the market. So I leave it at that. But again, there's more elements of comparison in the report. I don't know, Brendan, if you would like to add something to that.
Sure. Yeah. Thanks, Nicolas. I think the gap in the ratings between the European and US G SIBs has also narrowed, mostly with upgrades on some of the European banks. And that has reflected, I believe, over time, a gradual buildup in capital, as well as in what we call ALAC, or additional loss absorbing capacity that the European banks have built. ALAC is a concept that's similar to the regulatory TLAC or MREL, and it considers loss absorbing instruments in addition to your regular capital that effectively could be used as a source of extraordinary support. In addition to that, some of the European banks have had restructurings over the past several years on their business positions or risk management, such as Deutsche Bank and Barclays. So that's narrowed some of the gap. The US G SIB ratings have largely been stable in recent years, other than the upgrades on JP Morgan last year and then a couple years ago on Morgan Stanley. Nicolas referred to these. JP Morgan, Morgan Stanley were especially strong performers over a long period at their given rating levels. But other than that, the ratings on the US G SIBs have been very stable in recent years. On the market cap side, I think Nicolas covered that well. One thing of note is that JP Morgan's market cap is so large that it's almost as big as, I believe, the sum of the market caps of the European G SIBs. And again, I think that reflects partially some size elements, but also profitability and perhaps some growth and growth prospects. The U.S. economy generally has grown faster than European economies, although it's slowing now, we believe. So I think that's given a benefit to some of the U.S. G SIBs that have actually shown pretty good growth on their balance sheets as well as in revenue in recent years, and that's helped their market caps.
Thanks, guys. I think, there's a lot to talk about here. And as I said, the report does have some fantastic charts just comparing the banks and what you said about the capitalization, the size of the US banking sector or the G SIBs versus the others is quite fascinating. But we do need to move on. So I'm just going to move on a little bit to another aspect of the report, which I found really interesting, because we see increasing talk and questions about the need for regulatory simplification in banking, sometimes from the perspective that we have financial overregulation stifling economic growth, or that internationally agreed rules aren't appropriate for country-specific characteristics. Brendan, what does the report say about bank regulation for G SIBs?
We're seeing a push from G SIBs, politicians, different jurisdictions for regulatory simplification. And we're not especially surprised by this, given the amount of regulation that's put in place since the global financial crisis and the complexity of some of that regulation. So it seemed inevitable that at some point you would have this call to simplify and rationalize. That said, it won't necessarily have a negative impact on our bank ratings or how we see the strength of financial systems in these different jurisdictions, as long as the key guardrails that have been put in place since the global financial crisis stay there, and you don't see a material weakening in things like capital standards and liquidity requirements and the effectiveness of supervision. But a lot remains to be seen. The push for simplification and regulatory change looks like it's loudest and strongest at the moment in the US. The Trump administration, as well as those that it's nominated to lead the bank regulatory agencies, have commented on a large number of parts of regulation and supervision that they'd like to look at and change. But now we're waiting on details. There's also some risk we see related to that, to fragmentation, as well as global coordination. And the US is a good example because they're looking at things like the final set of Basel III endgame rules, and they'll have to decide how much of that to adopt. They'll also be looking at liquidity requirements and things like the LCR, as well as a wide range of other things. As we see proposals that come out and details that come in, we'll assess at that point and see how they balance just a bit of simplification and rationalization. Do they make supervision more effective and straightforward, or is it more of just an easing of regulation and supervision and a watering down of some of those requirements that we've seen put in place since the global financial crisis? So we'll see how that evolves in the coming months.
And then, Nicolas, maybe if I can bring you in, I mean, given what Brendan said about US regulatory simplification maybe being the most, I wouldn't say the most advanced, but perhaps the loudest calls, Europe is always concerned about competitiveness and the performance of its banks. What would keep you worried, let's say, about deregulatory moves in Europe and outside of the US?
Yeah, well, I think the similar thinking would apply here in Europe, the one that Brendan laid out in terms of the balance between simplification and watering down. What we hear at the moment are calls for simplification, also on this side of the Atlantic, led by some central banks, actually, and from, of course, some members of the industry. And also the ECB, for instance, has announced publicly that they have established some work streams to look at that. So there will be some simplification, that's a given. Now, watering down of rules, I don't think we have that in our base case. We've had a lot of thinking going on across the EU last year with some reports from Mr. Draghi, from Mr. Letta, to look at the competitiveness of Europe. And a key aspect that came out of those reports is the need for more integration of financial services provision in Europe, especially when it comes to capital markets. So there could be some policy movements there in terms of further integration of capital markets. But when it comes to banking regulation, I don't sense that there is a strong push in that direction in terms of watering down. Now, of course, this is a key element of our bank ratings, the adherence to global standards and the quality of supervision that comes with it. So we are, of course, watching that closely. But so far in Europe, we don't see a reason to take a more negative view.
Thanks, guys. Let's turn to another topic that is on the radar of many, private credit. The report shows the rapid growth in this area, in the area of private credit. Brendan, how are G SIBs engaging in this market to take advantage of that growth? But should we also be worried about contagion risks?
Yeah, private credit indeed is one of the hottest topics, given the rapid growth we've seen in that area recently and the likelihood that it'll continue to grow rapidly. And this also ties back a bit to regulation, because there's questions of whether bank regulation has been so strict that too much has moved outside of the banking sector, and that's facilitated a lot of growth in private credit as well as in non-bank lending in general. Now, that said, that doesn't mean the banks don't play a part, and they actually play a fairly key role in private credit. It's not that they're making private credit loans on their balance sheets, but they are participating in private credit in various ways. Most notably, they provide credit to the private credit providers. This is often in the form of secured financing, different types of warehouses and other secured lending that they make to private credit funds, BDCs, and various other non-bank lenders. This also includes the capital call or subscription financing that they provide to private equity funds and private credit funds as well. In addition to that, some of the G SIBs have quite large asset management or wealth management arms, and they may raise private credit funds or help their clients to invest in private credit. So they actually play a fairly instrumental role. A big question that has been raised by us and by others is, does this add to systemic risk? And I think this is an evolving area. When we see banks extending credit to the private credit area, it's often or typically done with good protections. It's often heavily collateralized, and there's a lot of structuring in place that provides protection. But given the rate of growth in that area and the likelihood that it'll continue to grow quickly, we do see an evolving and growing risk that at some point problems in the private credit funds and non-bank lending in general could have implications for banks and could cause credit losses for banks themselves. I don't see this right now as an outsized risk, but given how this is evolving and growing, it's something we need to continue to watch closely.
And Nicolas, maybe just if I can bring you in very quickly on this from a European angle, I guess private credit, we've seen, I don't know if it's similar levels of growth, but certainly very high levels of growth. And we've got the broader kind of non-bank financial institution sector. How do you see that evolving and the risks of potential contagion in that regard?
So with regards to private credit, I would say that in Europe, we are probably a few years behind what is happening in the US in terms of scale and importance to the lending sector from private credit, although it's been also increasing in size. But maybe to put it back in perspective, and we issued another report earlier this year on that, I think we have some numbers around the total assets under management of private credit funds, which was around 1.6 trillion, according to some estimates. And we estimate that the total non-bank credit providers was around 70 trillion, right? So this private credit segment is a fast-growing segment, but still relatively small compared to all the rest of non-bank financial intermediation that has been going on for years through various types of investment funds, some of which can be leveraged investment funds like hedge funds, for instance, some of which can have relatively short-term funding structures. So from a systemic risk perspective, of course, there's a lot of talk about private capital for all the reasons laid out before, also due to the lack maybe of transparency on some of these actors and transactions. But we think that there are other non-bank intermediaries that are potentially more levered and more funded short-term than private credit funds, and therefore could expose the financial system to more risks. So this is also an area that we watch. And of course, we look at banks' counterparty credit risk management and how they mitigate these risks as part of our rating analysis.
Thanks. Well, thanks to both of you actually for sharing some of the insights from this G SIB Monitor 2025. As we discussed, despite a pretty much weaker economic outlook and ongoing uncertainties, it seems that G SIBs are expected to remain resilient, pretty stable ratings, solid profitability, strong capitals, pretty strong liquidity positions. But looking ahead, that challenges of that regulatory fragmentation, that fast growth of private credit, and the need for continued vigilance in risk management sounds like they're going to be pretty central themes for the G SIBs. And the report makes clear that their focus on efficiency, diversification, and innovation should help them navigate those challenges ahead. We just touched on some of those, but do read that report. But thank you, Nicolas and Brendan, for joining us, and thank you to our listeners for joining us. For more details, do be sure to check out the full G SIB Monitor 2025 report.